Sky News Real Estate. Smart investing.
Hello and welcome to Smart Investing. I'm Chris Gray. After 10 years of hosting Your Money, Your Call, Your Property Empire and more recently Smart Investing, it's time for a change. Now, Sky Business will have a new show from next week called Your Money Live in collaboration with Nine Entertainment. And so for this very last show in this format, I thought I'd bring my three favourite experts together and discover the top tips that they've gleaned over the last 10 years. Now, unfortunately, Tom Panos has had to fly to Melbourne last minute, and so now we've got my two favourites, Charles Tarby from Century 21, Rob Southwell from Pitcher Partners, and I'm losing my voice as well, so we're going to make it the best show ever.
All right, I thought when you went through you were talking about yourself then.
Could be. So we've got our top tips, and we'll start with you, Charles. Call your agent. Don't wait for them to call you. Why would that be?
Well, the biggest complaint that you ever hear, or one of the biggest complaints you ever hear that comes out of Department of Fair Trading is real estate practitioners never got back to me. I missed the property because the agent never called me back. There's a whole series of things that go through that process, and it is wrong. It is wrong that the agents don't call back. I mean, I hate saying it, but you can go to an open for inspection and agents will ask you for your name and phone number, and most of the time you never get a call back. And you just wonder why they go through that process. So I think you're at a distinct advantage if you are in touch with the agent regularly. If you're walking past and you know what coffee they like, drop one in. Because I think at that point in time, if you're top of mind, because when I was listing and selling property actively, I would drive around and look at all the new properties that came on the market, and I always had in my mind which client it might match. And if you weren't top of mind, it's not that I didn't want you to look at the property, it's just you weren't top of mind. So if you're top of mind with a real estate practitioner, I think you've got a far better chance of getting the best opportunity than most people.
And that's the thing is, in this market, they're more likely to call you back, but certainly over the last 3 or 4 years, they wouldn't. And people will just whinge and moan.
That's right.
Whereas the ones that get the deals, they'll say, look, it might not be the way it should be, correct, but I'm going to go and be best mates with the agent.
How many properties have you bought, Chris, through your network that didn't even get to the market, that were off market? And that's what I mean. I said, if you don't have a relationship with your agent, you have no chance of getting an off-the-market property for sale.
99% of what we buy, we don't even go to auction because we know it's a waste of time.
Well, they think about you. They know you. They know what you like.
We take them out for lunch, we get them drunk, we take them on the boat, do whatever it takes.
Well, we have to draw the line there, but
obviously legally as well. So maybe we'll move off that subject.
Thank you.
Rob, your number one tip, use offset accounts to build a cash buffer.
So one of the biggest concerns, particularly at the moment when the banks are being a bit tight with their lending policies, is people being stressed about being short of cash or not having enough buffer. So a lot of people talk about having the ability to redraw or to be able to get another line of credit or something later down the line. And I think we're seeing right now that if you have to go back to the bank to ask for it, you're always at the whim of the bank. Whereas if you actually take the time to build a cash buffer that you can draw on when you may lose a tenant for a period of time, or you want to actually use that for other investment purposes, you have control over that. So things like offset accounts or savings accounts are a really smart way of protecting yourself, but also making sure that you can stay in there for the longer term.
And if you've got that spare equity, quite often it doesn't cost you any more to get a bigger loan. So if you've got $1 million property, whether you get pre-approved for 400 or 600 or 800, it's the same cost. Because you only really get charged when you pull it out. So you may as well get that extra if it's potentially on offer.
Absolutely, that's one of the main things I ask. I try and get as much as I can, and then the amount that I don't need, I stick in an offset account so I have access to the cash.
I've been trying to work out where I knew Rob from all these years, and it's that Aussie loan where they ask questions, and they said I want an offset loan, and the guy puts his hand up that helped them.
Is that Rob?
That was Rob. I didn't realise that. I didn't know you did work with Aussie.
Well, I didn't know either. I didn't get paid for it.
Now, another thing is maybe in this market you could actually even take it out of the redraw if you're that worried about the market and the bank's coming back and just pulling it from under your feet.
Sure, although
it might cost you some money.
But cost you some money, but also too, I think it's not really banks being able to do that in the first place. But I think if you're really worried about that, you can use and put your money somewhere else or with a different bank.
Now, my number one tip after the last 10 years is buy when you can afford to buy. So we've been doing the show, almost 500 shows, Charles, since 2008, GFC. And people say, oh, I don't want to buy then because the market's at an end. Then we've had a boom. Oh, I don't want to buy then. We've had high interest rates. We've had low interest rates. We've had easy to borrow from the bank, hard to borrow from the bank, easy to find property, hard to find property. There's always a reason for someone not to buy. Whereas my tip is buy when you can afford it, because you might not be able to borrow in 3 or 6 months' time.
And that's what's happened now. There are a lot of people who have been sitting on the fence, and the banks don't want to talk to them now because of the way in which lending policies have changed, and also valuations are going to impact on that as well. So now anybody who's thinking of buying has got a double whammy against them. So you're right. And people will look at the prices and they'll say, oh, gee, the market's going to crash, or it's going to go, that's what you've been hearing. So people say, gee, maybe I should get ready to buy. Well, good luck, because if you're not organised, you're not structured, you're not ready, you're going to suffer the same problem that the people who were ready to buy.
And those people in business, maybe business isn't going to be as good over the next few years.
Yeah, and it's usual story. I think Warren Buffett said you should be cautious when everyone's greedy, and be greedy when everyone's cautious.
Exactly. Now, Charles, moving back to you, maintain relationships with the brokers and the bankers.
Yeah, I shudder to think what my business would be like if I didn't have a working relationship with my bankers, because opportunity presents itself sometimes when you're not even ready for it, and sometimes it comes out of left field. It's something that you weren't even thinking about. But if you have a working relationship with your bank, and my banks get reports whenever they need, the reports are there, and mostly these management accounts and reports on the business will find their way to the bankers each month, even if I'm not ready, or even if they don't want the report. Sometimes they probably don't even look at what I send them. But I'm ready, and I'm ready at all times if something comes up, and I'm hoping they're in that same position. I have had situations where I said to the bank, looking at buying this property management business, they said, send us the information, send how your business is going. I said, you've already got that. And it just made the process so much easier. So I think and people who just buy and sell every now and then think I don't need them anymore. You don't know. You might need to refinance, or you might need to restructure, or something might come up that's better than what you've got, and you're being offered a good price for what you have. You should have a good relationship with your mortgage broker.
Absolutely.
And it's probably a reasonable thing as well off the back of that, is to always have your accounts up to date.
Yeah.
Rather than, right, I'll delay it, don't want to pay the tax. Quite often you won't have to pay the tax anyway, so you may as well at least get the accounts done.
Yeah, it never hurts to be on the ball and have your affairs in order, that's for sure.
OK, Rob, identify all your major risks and deal with them early.
Again, so being cautious, I think a lot of people get into trouble and not identifying the risks. So I think some of the major ones are, obviously from an income perspective, either not having a tenant for a period of time. So things like, obviously, the buffer that we talked about earlier, having things like landlord insurance can help. Looking at other risks around managing your interest rate. So if you've got multiple properties, obviously a quick movement in interest rates up may hit you, particularly if you've got a fairly large loan book. So managing your interest rate risk, having a really good property manager in place, actually doing all that as soon as you can after you've bought an investment property, or assessing it along the way, rather than waiting for the bad times before you fix it, because quite often you can't pull any triggers when things aren't going in your favour. So it's about risk management, and I personally, I look at those risks every 6 and 12 months, and to say, how am I travelling, and if this happened, if that happened, and you road test it, and that allows you to stand the test of time, which ultimately leads to capital growth.
It's amazing, isn't it, how much you can get done annually if you look at your interest rates and you get back to your bankers on various things.
Absolutely.
You can obviously negotiate downwards even when things are going up.
Yep.
The other thing that I got from your point there that I think is dangerous is commercial property. Yes. Some people will acquire a large commercial property, and from my personal experience, if I wasn't the tenant in my own properties, I would have a significant amount of trouble, because some of them, during the Sydney marketplace, I'll point out there, it's over there somewhere, during the Sydney marketplace, it was only 2 or 3 years ago, you couldn't rent commercial floors. You know, and then all of a sudden they became very popular to people to acquire stratas. But you'd sit there, and if you weren't the tenant, you could lose $15,000, $20,000 a month, and you're in trouble. You're gone. Yeah. You're gone. So that's
most resi investors wouldn't, mum and dad investors wouldn't be able to cope with that loss. No. And that leads into my second tip, is buy blue chip. And I think this is the perfect market to realise that, is that quite often everyone's after these shiny things, and I'll go for this because there's a rebate or some tax or something like that. Whereas this market, this is where the median price blue chip market is still pretty solid. And if you buy the right property at the right price, in the right condition, you get the right property manager, you'll always get a tenant. And it's those that suddenly you're in a niche market that suddenly you won't. So I think with all these, for buyers and sellers, it's just a solid market.
And there's something to be said. I mean, a premium property in a down or up market is still, you know, people say it's expensive compared to the rest of the market, and that's for good reason, because it is a blue chip property and it will be worth more than the market if you ever choose to sell it, which I think we're going to get to, which we advise never to do, right?
Exactly.
And also, too, you're in if you're in areas that are always in demand, you're never going to worry about losing a tenant.
And I think that's one of Tom's tips that he gave us before he couldn't turn up, was never sell. But I know you agents don't really like that. Nor does Tom.
I'm okay
the auctioneer as well.
I'm okay with that. I'm okay with that. I don't like selling property. I don't. And I buy and sell. If there's a better opportunity coming up, I'll sell to buy something else if I need to. But I really hate it, because at that point, whole point is about that growth. And blue chip, you're going to get more growth than you're going to get in regional or country towns. And so that's why you've got to really stick to that. It's hard though for some people to get.
It is, and that's a hard thing because of the price point, so it's not perfect. Okay. Charles, let's jump into your very final auction clearance rates.
Well, yeah, they'll be final for this show, they will, for sure. 55.5%, Chris, up 0.5% over last week, even after all of the bad news. So there you go. This time last year, it wasn't fantastic either. It was 66.2%. So it's getting closer and closer to each other. The Sydney market performed pretty well, 57.3%. So if you think about the Sydney market, and people have been playing it down, there are 850 auctions and 57.3% clearance rate of those. Melbourne had 1,158 auctions. And their clearance rate, it wasn't too bad at all. It came in at the clearance rate nationally at 55.5, so they're okay. But Adelaide was the best, 63.6%. There you go. And it was better than this time last year. And that is between Adelaide and Canberra, they've been really battling it out as to which one's going to be the best. Perth had a better clearance rate than this time last year, but only marginally. Last year was pretty ordinary. This year was only marginally. But Adelaide, is the best capital city for clearance rates. So there you are.
Wonderful. And homes advertised for sale?
Continuing, 1.05% up again. And that gives us a 9.82% of homes advertised for sale compared to this time last year. So it's pretty significant when you think about it. When you think about the buyers being lower and the banks giving you a harder time. Excuse me.
That's all right.
I didn't get that final scotch you promised me.
You're catching my disease. And the rent price movements?
Plus 0.92%. The worst capital cities are still Darwin and Sydney's dropping. Perth is improving, which is great, compared to where Darwin was. They were both really, really negative, so Perth's slightly improving. Adelaide is still going well, but I just think Adelaide will come off eventually, because it really is just the halo effect, of course, with what happened down there. So most capital cities are doing okay. Brisbane's doing okay, but again, Sydney and Darwin are the ones to watch.
And finally, the vacancy rates.
Can I die first? 2.7% for Sydney, was pretty good. Melbourne, 0.75. There you go, that was really good. And Perth, 6.55. Really fantastic figure, so 3.33, all up.
Well, hopefully you'll survive the other side of the break, Charles.
Thank you.
Thank you very much for those numbers. Well, coming up, more all important tips and tricks on getting the best deals in real estate. Stay with us. We'll be back soon.
You're watching Sky News Real Estate. Smart investing. Welcome back to Sky News Real Estate. Smart investing.
Welcome back to Smart Investing. Well, joining me on the very final Smart Investing show is Rob Southwell, Managing Partner of Pitcher Partners, Accountants and Advisors, and Charles Tybee, Chairman and Owner of Century 21 Australasia, the two longest titles I've ever heard. Charles, your tip number 3, focus on capital growth ahead of rental returns.
Now, this really burnt a lot of people, especially during the mining boom. A lot of people were focused on that rental return. You know, go to these mining towns, you get 2, 3, 4 times the rent. There were places being built, developers going out there, properties going up, all because of this. And of course, you look now, and they cannot, not only have they halved their asset and more, and they have to keep what they've got because most of them are in negative equity, there's no rental return, nowhere near the rental return they were getting. And that to me is always a big issue. A lot of people focus on rental return And I've never forgotten about one of my employees who bought a one-bedroom apartment out at Kingswood all these years ago. And apartments or units were really not that great then. And 10 years later, she sold it for the same price she bought it for.
Wow.
Because at that time, out west, past Parramatta, that was a long, long way away from everything. And she had a good rental return, but no capital growth. Of course, that's changed out there now.
Yeah. And I guess on the back of that is we're all for education on the show, but sometimes they're going to these seminars that are promising the world. They get 20% rental returns and then it changes.
Correct.
And that was the little bit they didn't listen to or they weren't told.
Yeah, capital growth is critical, and people who don't balance the two will find themselves in trouble.
Now, Rob, your next one was use multiple lenders.
Yeah, so I mean, following on from Charles' point, it's really good to have a really good relationship with your banker and your mortgage broker, but I think it's also quite smart, particularly in the current environment, to use different lenders. They will have different attitudes to different styles of property, different policies around what they lend and so forth. But I think it's still very important to have a good relationship with your primary banker, but don't be at the complete behest, beck and call of a single bank. So
yeah,
yeah, it's interesting. You know, you've seen back in the 80s and 90s where loans were called up, and that got pretty close too in the early 2000s, where banks were looking at calling loans up because they had liquidity problems during the GFC. And if you were with one bank, and I know one developer who was a major developer, he got his loans called up. He lost everything. Because when you have to move things in a hurry or sell things in a hurry, you can get into a lot of trouble. And if you don't have your loan book spread, you can be in a lot of trouble if you're not careful.
And again, I guess a lot of people go with a single lender because they think they're going to get bigger discounts. But if suddenly one property is going up and the other one's going down, you haven't got the ability to do a lot. Or even if you sell one, the bank may still keep the equity to put against the other loans.
Exactly.
So you can't necessarily pull single ones out.
Yeah, exactly.
Now, my next tip was always get a valuation. This is probably one thing I learned maybe probably about 15 years ago, and I reckon it's the best tip ever, is if you get an independent valuation, and not a $20 one online, it's one that's maybe $500 or $600, the value has actually physically been in the property, he's then spent 2 or 3 hours actually doing comparables, I reckon it's pretty hard to go wrong and buy a wrong property for the wrong price.
It is, and you know what though, you've got to work with valuers. This is another area that a lot of people don't recognise. You often don't know who your valuer is. They come through a bank channel, but you can find out, and you know, if they certainly turn up at your house to value your property or things of that nature. I've always prepared a report for a valuer on anything I've bought, and I've sent that down the line to them, said these are all the properties that are sold in that area, this is what's for sale in that area, here's what I think the price is, and that way they really have to have a close look, and you've done a lot of their homework for them. So whenever I've gone out and bought things, I've always done my own valuation in a document form and forwarded it down the line. It makes people accountable, so I don't think that's too bad an idea.
And it's much easier to do it nowadays, say 10 years ago, because there's so much information available on the internet now.
Yeah.
So.
And look, I used to do it, and it used to probably take me about half a day in those days to do all the pictures and stuff.
Yeah.
But it's a good investment because even if it's a refinance, to get refinanced up from 500 grand to maybe 550 or 600, you may be getting 80% of that, so 40 to 80,000 for half a day's work.
Yeah.
I reckon that's pretty good pay.
Yeah, and some properties are worth probably a bit more than what they're selling for, but most valuers, of course, they're not going to value past contract price if that's been presented to them. So it's really a really good idea to prepare. It's like the agent, hassle the agent, it's like the banker, stay with your banker, work with your different banks that you build your relationships. I think it's the same thing all the way around.
And look, we're doing it even before we agree on the contract price. So we're doing an independent one on top of our bank one to prove what it's worth paying on the contract before we even sign the contract.
I've had circumstances, Chris, where the banks will give me the list of panel valuers they have, and if I've worked with them before, I'll call the valuer up and say, hey, it's me, oh, good day, how you doing, what have you got? So I'll tell them it's this, and they pay attention to it because they know you're a regular person out there doing things.
Now, Rob, your next one was get a good advice, but probably more importantly, and follow it.
Yeah, so I guess in our industry we give people a lot of advice, but the amount of, and in property particularly, you see that people have their own views, they have their own concerns. Getting good advice is one thing, but actually following that through, because quite often people are nervous or hesitant to do that, or just plain lazy quite often, and the amount of times that people don't follow advice and then down the line said, oh yes, you told me that, or someone told me that, that, I should have done it, shoulda. And in the interim, you've missed out on an awful lot of capital growth or upside. So it's one thing, if you're going to go seek someone's advice and you trust them and they've got a proven track record in giving good advice, then follow it and do it. Pretty simple, but quite often...
Charles, off the back of that, friends, family, around the barbecue, it's probably not the best place for advice, is it?
No, I would battle with people like that, because whenever I'd show a young couple a house, they'd always want to bring Uncle Louis to have a look first. And Uncle Louis may not have been around real estate, but they trusted Uncle Louis, and the first thing Uncle Louis would do was defend them, you know, in the sense of stop them from making a decision, because he was scared that if they did make a decision and it didn't work, he'd be to blame. So often the advice you get around family is not that good.
My next one was just do it. I think everyone's got a reason not to do it. You're never going to have the perfect information, so at some point you just got to jump in.
Yeah, at some point in time you do. There is a little tag to that, if you don't mind, Chris. And these are some people, as a real estate agent, people say to you, when's the best time to buy, when's the best time to sell? And you always get that, oh, now's the right time, this and that. The reality is that sometimes it's just better to not jump into the real estate market for the sake of getting into the market. And some people do that. They, oh, look, I bugger it, I can't get in, I'll just go and buy. And they end up going down that road we talked about before, high rental return, no capital growth. So there's just a bit of a tagline to it when you look at it from that point.
And a very quick one, Rob. Tax is easy to manage if you don't sell it.
Yeah, it's a question we get asked all the time. What tax would I pay if I sold my property? I think it's the quickest way to diminish your wealth. Property is a long-term game. If you bought a good asset, you know it's a good asset. Unless, and as Charles suggested before, unless you're moving that into an even better asset, then don't cop the 25% tax, the stamp duty and the sales commission. Just to do that, you'll diminish your wealth pretty quickly.
Exactly.
Excellent.
Now, one of the things that we get asked on the show is what actually happens behind the news desk and what do you all wear? Now, I think the other two might be a bit shy, but as being property investors, long-term property investors, ideally we don't have to work for a living all day, every day. So quite often we're coming straight off the boat and literally off the boat or off the beach, and we're in our boardies, and then obviously wear the dinner jacket as well, just to behave.
And
that's what we've done for 10 years, isn't it, Charles?
Well, that's not we.
Some people. Not all.
What's this we business, white man? I think is what the tagline is.
Anyway, thanks all for joining us on the show and for all the support over the last 10 years. We've had plenty of people that have emailed in, called in, and I hope you enjoy the Your Money live show from next week. It's great to have got so much feedback from all the clients, and hopefully there'll be more to see with all of us, hopefully joining on the new show as things change. Now, just remember, you can keep in touch by joining our property updates at yourempire.com.au, and if you haven't downloaded my book already, you can download a copy there, The Effortless Empire, for free, and also join us on Facebook or Twitter as well, just under Chris Gray at Empire. All right, thanks again for joining us, and until next time in a different environment, I'm Chris Gray. Until next time, good night.
Information presented on Sky News Real Estate is general in nature. Viewers should seek their own professional advice before purchasing products or services. Sky News Real Estate may receive a fee for commercial arrangements with companies featured in this programming.